Hello, and welcome to the EmpowerED Consumer Podcast, where we talk about all things people, policies, and progress shaping Eswatini's non-bank financial sector and the regulation around it. Seated with me today, I have Mr. Thabo Magagula from Umelusi Group, Mr. Ncamiso T, the CEO of the Financial Services Regulatory Authority, and Mr. Zama Ngcobo, the General Manager at Eswatini Royal Insurance Corporation. My name is Nobanda Dlamini, and I am the Customer Experience Manager at FSRA. Welcome to you all. Gentlemen, welcome. Can I allow yourselves to introduce yourselves? I'll start with you, Mr. Ngcobo.
Thank you, Nobanda. My name is Zama Ngcobo. I am the General Manager of Eswatini Royal Insurance Corporation, and thank you for the opportunity to interact with your office.
Thank you, Kosi. My name is Ncamiso T from the Financial Services Regulatory Authority, where we look at a wide array and landscape in the non-bank financial services sector.
Thank you, Kosi, for having us. My name is Thabo Magagula. I am the Executive Chair of Umelusi Group, a highly regulated enterprise in the non-banking financial services sector. Thank you.
Welcome once again, gentlemen. Thank you. Today we'll be taking a deep dive into Eswatini's regulation space. We're talking about how life has been pre-regulatory era up until the current era now, where we are functioning under the regulation of the Financial Services Regulatory Authority. I will start with you, Mr. Ngcobo. Can you tell us what it was like operating in Eswatini's non-bank financial sector before FSRA came into the picture?
Yeah, that's a lot, Nobanda, for that. I think maybe just some indulgence from your side in terms of the role that the insurance sector plays within the overall financial system in any country. You'll appreciate that insurance plays a major role in terms of financial stability, funds, collect savings from the nation. Insurance also promotes things like trade and commerce, as it were. So it becomes very important with that in mind then to have a sector that is functioning. But in order for a sector to function properly, it has to be properly regulated. Now, prior to the office of the regulator, it was a bit tough, actually. If I were to use the analogy, it would be like we're playing a game without rules. Now, it was unpredictable. You will recall that it was not surprising then that you would have clients, consumers saying insurance were done. Because one, they never understood what was expected, and also they had to rely on the goodwill, if I were to say, of the players at the time. But yes, I must say, even for the insurance players themselves, they were not too sure of what was expected of them. But fortunately, we didn't have major problems at the time. You will also recall that the central bank was also playing a role in terms of that. So was the Ministry of Finance at the time. But there wasn't a specific entity responsible for that. That is why when the Registrar of Insurance and Retirement Funds was set up, it made a lot of difference in terms of how the industry was going to be regulated. The players, the consumers themselves, it has made a lot of difference. But way back then, it was very difficult in terms of knowing exactly what was expected of you as an insurance player.
Thank you, Mr. Ngcobo. So how did you traverse those spaces where issues of mistrust came up?
It was difficult, actually, because one of the things that seemed to have occurred at the time was that the consumers were not empowered in terms of understanding the products that they were buying. And also the insurance companies, I don't think they spent a lot of time understanding even their own products that they were selling to the consumers at the time. So when the regulator came in, it required all of us, those who were in the space at the time, to then take a step back to say, are we doing the right things? Are we giving clients the value that they are looking for? But most importantly, the whole issue of a mechanism where clients could then raise their complaints. That's what came up with those developments as it were. So yes, that has been the journey ever since. You may ask, how was it received at the time? It was difficult because for the first time we were being regulated as an industry. At the time we felt that maybe there was some heavy-handedness on the part of the regulator. But over the years we have seen the value of that development in terms of changing even how we do business, how we operate, how we treat our customers, and even internally in terms of governance structures that have come up as a result of regulation within the industry.
Beautiful. Thank you, Mr. Ngcobo, for that response. Mr. Ntshalintshali, over to you. FSRA was established in 2010. What was the core mandates then, and what did the early days look like?
Thank you, Wanda. We have traversed a journey as the Financial Services Regulatory Authority predating 2010, where in the early 2000s, around 2001, 2002, there were major financial sector reforms in the country, which gave birth to a number of financial sector laws, which would include the Securities Act, which came in 2010 with the FSRA Act. But before that, there was the Retirement Funds Act of 2005, the Insurance Act of 2005, and over the commercial banking space, there was a review and an enactment of the Financial Institutions Act in 2005. So in essence, when we gave birth to the regulation in the non-bank financial services space, we started with the two major industries, including insurance and retirement funds. So around 2006, 2007, I would say that's when things started to pick up to then bring into the regulatory net those big sectors. It was a time where it was a fragmented approach that the Ministry of Finance, straight from that department, they were dealing with the issues of regulation around pension funds and insurance in the country. So when the Registrar of Insurance and Retirement Funds was set up, then it sort of provided some structure and some balance in dealing with these issues. Early days, as Mr. Ngcobo has indicated, it meant that we had to come in a bit robust. It's a very nice way of saying militancy in a very polished way, because we understood what was at stake. We had to ensure that as these products and services are being taken up by a Maswati, there had to be that sounding board, there had to be that measured voice and action that had to come from the regulator. In trying to say over the years, there were many of these entities operating out of foreign, outside of our borders, and we did that then to normalize and bring them in. Some of the entities that we see today were always operating through agents and through intermediaries, but now we needed to set up this industry in the country. We also had some work that was done out of the central bank. It was the Capital Markets Development Unit at the time, which was housed at the central bank, dealing with issues around the capital market space. So we had licensed at that time or given authority to operate by the central bank, including Stanlib, African Alliance, and later on Sanlam, which has evolved now to be FSRA. So those were the first three registered participants in the capital market space. So when FSRA then was set up in 2010, started full operations around early 2012, we then had to bring these departments, which was the RIRF and the capital markets, within FSRA. We also had to set up now another space that deals with consumer credit, building societies, the entities including Select and Letseho. They then had to come out under another area of supervision in the FSRA. So you would then see that there were quite a number of entities that were already licensed before we came in. It then became an interesting fancy footwork that we had to do to bring into these experiences and understand that our goal is not to disrupt but to bring order. Now we are bringing order in a different set of rules and norms. We then had to ensure that we move with our stakeholders. At the time where I lose the right frame, but we're dealing with savings and credit cooperatives. It's an interesting sector. It has been orderly in its own way, because the movement, as you see, started way back in the 60s in the country. It's one of the largest in numbers. It involves a lot of masses. But when it came to regulation, it was a very foreign concept to them, because regulation was understood to be the Minister of Agriculture and Cooperatives at the time set up this manner, and then they moved into the commerce and industry space. So in that intervening period, then the FSRA comes in with its own strict mandate, as it were, at that time. So we had to go through some learnings to understand each other and to bring the comfort that what is regulation, what is financial services supervision in terms of our mandate. Now the FSRA Act then brought in some core intentions. We want to have an orderly, a fair and a healthy financial sector. We have to promote a financial stability. We have to ensure that the entities that we're supervising are adhering to the strictest market conduct principles. We have to ensure that they are promoting fair competition. So as you see that, it encapsulates a wide and a circle of responsibility between the regulator and the entity. We consider these entities to be the gatekeepers. But our sixth object as a financial services regulator is to protect stakeholders. Now, I like what the intention of the legislator was, to say protect stakeholders, not a isolated class. One at the stage would say you protect consumers, but these entities that you are supervising, they're part of the stakeholders. The policy maker is a stakeholder, the legislator is a stakeholder, the provider of these services and products. So it then says, as a regulator, you can never be of one mind when we are dealing with the space. We have to bring in both participants, the consumer and the provider, to ensure that the space is safe. So that has been the learnings, and the greatest value that we've extracted out of it is to ensure that once calamity strikes, once there is a failure in the space, which obviously want to be an isolated event, it is not just a matter of the consumer who has lost. There has to be responsibility by the entity that has slept on the wheel to ensure that we don't face the similar issues as we go. So it's been bittersweet, but we have sort of enjoyed the space that we have marshaled, the space that we have had oversight on. It has given us quite a number of lessons as well on how to deal with an insurer when they don't want to pay when an event happens. But what you then lose, they say that the devil is in the small print. In some instances, you would say long insurance, but you were really never covered for that event. Because the wording is key when it comes into an insurance arrangement and agreement. So those are the issues that we always have to bring above the line. When an insurer is here and says they've covered this, they mean if you drive a car without being a responsible driver, the consequences will have to fall on you on a different way. But as a regulator, we do have to bring that knowledge, we have to bring that consumer education up above board, above the line, to ensure that the space is balanced. Thank you.
Oh, beautiful. And I would like for us to talk about that consumer education a bit more later on. I heard use of some keywords there: military, militants, fancy footwork. What are you saying, Mr. Ntshalintshali? How was the reception from the industry when FSRA first came in? Would you say there was resistance?
Most definitely, you would see different perspectives. The point of view of a regulator when they come to institute changes in behavior, you do want to say, I have got my non-negotiables.
as a supervisor. But those non-negotiables, they come in understanding that there was a business, there was activity before the law came. The legislator always anticipates these things. So they would say transitional provisions. In our legislations, that's Section 91 of our Act. It would say if there was an LTT operating within 6 or 12 months, depending, they would have conformed and applied for a license. For a new entity, there are different set of rules that come in. It gets a bit interesting when you are saying, as a regulator now, I am saying insurance is legislated as a area of interest, and within the regulatory ambit, you come in with an SRIC that also has its own legislation. So when our legislation comes in as an FSRA Act or an Insurance Act, it has to infuse those experiences. Now, there are certain things that SRIC was dealing with in terms of their agents and intermediaries that have to stop. They had grown accustomed to certain behaviors and practices. Some probably may not have been harmful in their view, but we see that down the line, it's then likely whether we are saying those agents were coming out of a foreign jurisdiction and now want to localize to say intermediaries should be Eswatini. Eswatini, they come in, the levels of capacity still have to be built, the experiences to be built. They're not going to like that and say, no, but our business has been operating firmly and responsibly. But we anticipate that as a policy measure, it should change. So those are the issues that you would find that they would hit a wall. There will be some manner of soft resistance. I mean, they're still here, the license is still operating, and want to believe, as we see information flowing, but it's a prudent entity. But what happens when a catastrophe hits and the balance sheet is wiped out? So those are the anticipations that the regulator has when they institute certain behaviors that have to change. So there are issues of commission scales that now have to come in and be regulated. There are issues of the big elephant is always the levy, and saying, why are we paying a levy? Why, legislation says the regulator may bring into the attention of regulated entities, and that's Section 21 of the Act. We consult with them. It's never a once-off or thing that we come up with overnight, and we bring the principle across. But it's still saying my income statement now is going to be impacted, and those are reasonable conversations that we have. So the resistance you would find that not intentional to say, no, we don't want regulation, but to say there's some disruption of the business as we know, and how do we in a way work together. And that is where then we come and say, and our legislation put it very clearly, but whenever there's a change, you bring it to the people that it's going to affect. So you don't just come and say, I've got a new set of rules, now comply. It may have been, and it still happens, there are certain matters that would be of importance and significance that you may find that it doesn't really bring much harm, but the manner of implementation have to be sped up. So instead of giving 30 days for reflections, would say, please respond to us in 3 or 7 days. But what is critical there is the relationship that the regulator has with the entity. So if there are no daggers drawn against each other, you'll put 5 days and you'll receive it before the close of business on the first day, because you've cultivated that kind of relationship and posture and landscape that understands that the regulator is never one that comes with an X, but is one that comes to correct and manage a particular event. So we have experienced, and we know that we have been militant, and we are still going to be firm on certain issues as they come affecting our space. But what critical and responsible, of course, is let's move together as an industry. Ultimately, the consumer of these financial services products is the one that should benefit out of the roles and the legislative mandates that we have as different partners.
A mouthful indeed. Thank you, Mr. Nchalintshali. It has been some interesting insight. I can't imagine it would be easy for FSRA. On the one end, we want to keep these excellent stakeholder management. On the other, we have to be very firm with regards to consumer protection, because ultimately that's what it's all about. I can't wait to hear what Mr. Magagula has to say with regards to those worries and functioning under that space. Mr. Magagula, let's move on to you. Umelusi Group was established under the regulatory space. How was that? How was that journey?
Thank you, Novanda. It's been a long journey. It was before FSRA, it was the retirement fund space. We were all many with the regulator. But obviously, I think for small and grey enterprises, the issues are always focusing on your bottom line. So the natural thing is to find the burden of compliance to be there. So before, when it started off and the regulations kicked in, everyone was traumatized because they were seen to be a bit rigid. And it was distorting the way businesses were being run. For instance, when we started, we needed to get a broker license. We didn't need a broker license, but they could need a category to allocate us. So the rules or the regulation was such that if you wanted to play in the intermediary space, and it hasn't changed much, we could only be a broker. And then there are a lot of brokers out there because everyone just could only get that license. Obviously, as things have changed, and things will continue to change. But the toughness was the burden of compliance, and it's still there. But I guess with time, you grow, you evolve. And before then, I think, as Zama Ngcobo was saying, so it's a good thing to have the regulator, but we must say it's painful, as it were, because the cowboys obviously fall out, and those that want to be in the business, they clean up their act and they conform. But then I remember when I was running, at the beginning we had the broker license. And the biggest thing is you had brokers, obviously, were working for you. And they would come and sell you a policy here. They knew that the commissions would come up front. And they'd go to all three of us, SRIC and whoever else was actually the insurer or the broker. And you would pay them their commissions. They didn't care that after 3 months, the policies would lapse, and take the same policy, run it over to an entity B and do the same thing. So that's because before then, the commissions were paid lump sums up front. But the regulation then saw that, no man, there's a distortion here, the way this thing's being done. And now you have to really build a business because you're not getting money up front. And the person who was suffering the most was a broker, because they were the ones who were liable not only to the insurer, but also to the regulator to say, what's going on here? The person who's your agent working within your brokerage has taken their commission, and they're not liable for the service that they're giving. So then regulation came in, and you sort of needed to treat everyone fairly, and therefore you needed to align to your entity and needed to align to the regulation. You're not shooting off the hip and taking it was really becoming a scam. So the regulator himself, as much as we are complaining, we found much value in it. And two, we also now appreciated that there would be development within the local space of local talent or local business or local opportunities. But it's painful to be regulated, but it's good for you. It's like an injection.
about the comment, stick going up your nose. It's painful, but they say it's good for you.
A necessary evil.
So yeah, before then, I think the pains were there, and we did find the regulator then very not rigid. I can say. I think the character was we need to enforce, and sometimes I guess you need to do that so that people can feel that you need to change your ways and conform. But we're still young, and now we've grown older and wiser.
Oh yeah, well, it's beautiful.
Yeah.
So it's been over a decade of functioning in the regulatory space, and who are saying the regulator then seemed quite rigid.
And very understanding.
Yet somewhat understanding. How would you, if you had to provide a comparison between the regulator 8 years ago and the regulator today, what would you say?
From an industry player perspective, and for someone who's grown from small to mega media, then it's moved from the authoritarian style to the more collaborative style. But again, the industry takes time to grow. So even though it grows, there's more responsibility. But I think we've been phased in nicely. And like I say, there's never been any pain. Oh, there's been pain, but it was not unwarranted, even at the beginning. But now we are finding that it's not as punitive, maybe. And even it's because we've grown to understand that when your parent slaps your hand, it's not that they hate you. They're just trying to correct you. But at the time, you ate them for that moment. So I think that same sort of appreciation is there. You're not dealing with your parent as adults, so you have different conversations in different environments. But the environment in which you operate has broadened and has grown over 8-10 years. The regulations have changed, and we are seeing that it's allowed for the market to actually mature. Maturity comes with responsibility. Speaking as any person, we all don't like responsibility. Because responsibility says you need to be confined within the rules. And again, being confined within the rules, you find that you can't shoot off the hip. And that's where opportunities lie, when you're not working within that related space. Sure. And I've always said to the CEO that the guys who were there before the authority or the regulations had much more leeway to do all sorts of things and get away with them, if that's the right word to use. But they were able to express themselves. Now when you sneeze, you have to have a handkerchief, because there's regulations around sneezing in public. Yet sometimes people would sneeze and no one cared, So, but it's a good thing. But we're just saying that in maturity, the industry has grown, and it's allowed for a lot more authentic businesses to operate. And not to say that Anthony for, but we've seen the little gaps here and there, but it's still part of the growth of the industry. And we all wish we would be babied till we die, but unfortunately, we have to go up at some stage.
Yes, there was a time when I really wanted to go up. I don't know why now.
Why did I want?
It's not making sense.
Yeah.
But thank you so much, Mr. Magagula. What a beautiful response and an interesting set of analogies. I'm sure that the viewers can certainly relate to what you've just said. A very insightful response from Mr. Magagula that I think that we can all relate to. Some beautiful analogies in there. Mr. Ngcobo, let's come right back to you. Now that you've been operating under FSRA's framework for some time now, what do you think has changed from then to now in terms of your operations?
That's no wonder. A lot has changed in terms of our own business now internally. One of the things that have changed is issues of governance, as it were, right from the level of the board, committees of the board. We now have to make sure that all areas are attended to. The second thing is that we, as an industry, our clients now have confidence in us in terms of saying that this is a regulated entity, they can't do as they please. And I think the point I raised earlier, that there is also that complaints handling mechanism, the Office of the Ombudsman, which helps us also as a business to say what are the areas that you need to focus on. Another thing, of course, is in terms of the accountability, which we mentioned earlier, to say that we know that we are now accountable. Every quarter we have to submit returns to the regulator. Now, the advantage of that is it helps even the regulator. If something is not going right, it's the regulator is able to pick it up earlier, as opposed to waiting until things have gone horribly wrong. It has also helped us in terms of the infrastructure that we have had to build to run the operation, as it were. Our investment in the computer systems that we are now using, they help us to understand the business even much better, something that we never were expected to do way back then. And also the type of skills that we have had to develop in order to respond to the changing needs from the clients and also the regulator. So it has made a lot of difference in terms of issues like compliance. We've had to set up a new department run by 4 people. It's costing us some money, but we want to believe it's worth it, even for our own benefit and also for the benefit of the insuring public. And of course, how we are now using service providers like actuaries, accountants, and all that. It helps us to understand the business even better. I think 2 years ago, IFRS 17 came into the picture. It is one of those developments that are helping us to shape the industry even much better in terms of reporting, but most importantly, transparency within what we do. I think that those are some of the takeaways we have had and the developments we've seen from the coming in of the regulator. We do appreciate the interactions that we have from the regulator. I think Mr. Magagula mentioned it, that interaction in terms of them showing us why they are doing certain things and how those things are benefiting us also as the players. And we are looking forward to more of those interactions as we all build that industry. And I think it has helped, no wonder. Things will go wrong, but I can imagine what the situation would have been had we not had the regulator playing that oversight role. Our clients can sleep at night knowing that there is someone who is watching after their interest in terms of this insurance industry and retirement funds. I think that would be what I would say been the advantages and also how we've transitioned from that.
Yes. Thank you, Mr. Ngcobo. We've certainly come a long way. I think at some point, I was young, I was a baby then, but no, I'm kidding. I was very much there. At some point, we felt the relationship was one way and we only showed up or mattered when an event had happened and, our insurer needed to play an exact role in our lives. Now, we as consumers, consumers of the financial services products, it's nice to see these open door policies, whether it's voluntary on the part of the entity or if trade space is sort of influenced that. But it's nice for the consumer to be able to know that, to understand the products, to question things, a power that the consumer did not have in the yesteryears. Mr. Nchalintshali, hearing Mr. Ngcobo's submissions, and obviously I'm sure there's more on your mind, what are some of FSRA's achievements that you are most proud of to date?
Thank you, Nkos. I tend to, in some instances, ride on a phrase can be taken from both ends, that in a period of wartime, we forget the peacetime. And in periods of peace, we vaguely remember that there was once a war. The achievements of a regulator are best in instances tested when there are problems. A market that fails, one asks themselves, where was the regulator? But during those number of years, when the environment is peaceful and orderly, it's a different story. But when we take to maybe chronologically from when we were set up until now, the taste is in the pudding. You look at market statistics, you see that the market has grown, you see that the industries have stabilized and have matured. But of critical importance is the local players in our market. When we came in 2006, 2007, we had one insurer, and I'm sure he doesn't like when we take up these reports of market share and saying that people are encroaching into his space. But what that says is, because the pie is not shrunk. When you look at his growth as well, year on year, they are growing. But there are also other market players that are in the space. We throw these, and at the time there were swear words to say demonopolize the insurance space. It was a, that you wouldn't use it leisurely. But what it meant is it also triggers innovation on their part. How do we stay relevant? How do we keep our players? How do we ensure that as much as the wallet is not growing much for the consumer, but they are getting value and benefit out of the product, service, and the offerings that we take out to them? So I look at that and say, yes, there was militancy, but the numbers and the local players that are in, I cannot then overemphasize as well that the regulator herself has been a training ground for the industry. When they speak of compliance needs and where can we get the sharpest minds and skills, they always come and talk to our people, and then they entice them in. And we can always say that, you worry of the greener grass across because it's winter now. If you stayed with us during the previous summer, but again, it's evolving. So we have a more protected consumer base. We've got a more aware and banked. Because when we look at the time, I would relate to the SACCO space. We came in, they still have not grown much in terms of numbers, but the quality of their balance sheet, it's reflective of the benefits of supervision. We would always fight when it's time to declare dividends, because they would come and say, we promised that we're going to give our members so much. But we sit and say, no, but your capital ratios and your prudential ratios are not speaking to that. Hold off 2% of what you've promised. We fight. Some of them will even camp here after hours and say, no, please sign off ARA. And we'll say, we're signing off with a caveat. There is a condition. If you continue declaring this much, we're going to have problems when you come back from your membership. And it's been slowly ingrained into those behaviors and practices. Now we're seeing it's pushing close to 3 billion. And in about 8 years ago, it was sitting at 1.2 billion. So it has sort of doubled over this period. We're speaking of a non-bank financial services space now with an asset base of over 100 billion. It was never there. And you would say, obviously, the market responds to that and all that, but they are also the leading guys who are saying, let's make the investing vehicles, let that be there. Let's grow the market. Let's support what the monetary policy tends to infuse and direct on a particular basis. So it's been a coordinated effort. Then you look at, I'll use an analogy, that it's not even an analogy, it's real, it's science that has been tested. That air travel remains the safest to this day. But you would have Boeing MAX problems. We are going to have planes falling from the sky. But at the balance, it's still the safest way to travel. Financial services have moved from a by the way thing to be a need in this day. You cannot function. We say now all the services are in our palms. We want to transact everywhere. You cannot now conduct a lifestyle without a basic a suite of financial services products. Sitting at the core, we want to move to micro pensions. Private pensions, we are employed, you are covered. But there is a great balance and a great number in our population that still have to tap into pensions. Now we realize against what people may think, I'm closer to 60 now as I was 10 years ago. And we know 60 to be a trigger that you now have to. But now we are very energetic at 60. And I ask myself, in the European market, they are moving retirement to 65 years or 70 in some sectors. Are we ready for that conversation? The unemployment is high, skyrocketing. So you want people to, kuzupume in our terms. And then it means the regulator, because we have to lead on this. What are we saying about micro pensions? We've dealt with micro insurance. It still has its own problems. That's also another achievement from the regulator to say we have come now, we have a reinsurance legislation. We are repatriating back reinsurance premium to the country. 20% is fighting it to say it's too much. I find it to be just a drop in the ocean. But it's because what I said, I don't have the issues that they have to deal with them on a micro basis. We converse, we continue with the conversation to say, it will mature. It's a legislation that is new. Probably after 10 years, let's think of moving it from 20% to 25%. What is it doing for the economy? It's keeping business here. It's keeping confidence. Because as a financial sector, you want to say, if I see people lining up, withdrawing from Umelusi, if I have my investments there, will I jump at the queue and withdraw as well? But if I know that I'm safe, I will just pass. I will not even ask why they are queuing, because I know that the regulator has taken charge and has ensured that there is safety. So those are the issues that we would want to say, as much as it may appear to be a ticking of the box, but with us, we want to be resolute, we want to be deliberate. But the space that we have been tasked with by legislation, we execute our mandate fairly. There are developments. You will see going forward, entities that we supervise will be graduating to other institutions, will be a bank. You have to understand that they are at that level because there was some measure of supervision and resolute supervision. We engage with their partners. Some would have credit lines with international organizations, the FDB, some even from the European market. Whenever they are doing due diligence on those entities, they come and touch base with the regulator. What are we seeing? Are there worries? Not to say you are endorsing that facility, but from the conversation, you see that they had confidence to invest in this entity because the entity is supervised and the regulatory environment is predictable. There are no surprises. So that is what we stand for as the FSRA.
Beautiful, beautifully put. I like the words that are flowing in this conversation. Militancy conversation, stakeholder engagement, protection, but it's lovely. Mr. Magagula, it's over to you. Mr. Ngcobo was just telling us how regulation has helped shape the space in which he operates in. How has it helped grow your business?
I can accredit all our growth to the regulation. The staff wouldn't have been able to ever do had there not been the regulator and the regulation. We can boast to say we manage over 2 billion assets in whichever shape or form. It's because of regulation, because regulation has now compelled that there be some growth within the sector. And we can always push and negotiate and lobby the regulator to enforce a bit more. I mean, there's this 30% requirement for assets to be managed locally. It all of a sudden said, as much as everyone was used to taking money to South Africa, and then the guys do everything, we now needed someone who could look at the local markets and look at the local opportunities. It could only have been the locals. And that's because of regulation. So, and you have found that from a point of view where we had, as the CEO said, 3 or 4 players in the asset management or the fund management space, or even the brokerage space, we now have about 10. So that has been good. Then we've employed more young people, graduates who are now being analysts, who are doing compliance. But for us as a business, we've got nice fancy offices. You can come there and you've got nice fancy professionals, graduates who are now doing stuff that under normal circumstances would be done in Joburg. And that's really the beauty of regulation. And the FSRA has enabled that to happen, ensuring that preference must be given to the guys who are able to establish here. And that in itself said they're now going to employ local CFOs, local analysts, local, senior and junior people. And then we start poaching from each other. And you can imagine that before the regulator, you only had one stockbroker in this country. It was Southern's stockbrokers. And then after that, there was African Alliance Stock. Now we're looking at about 5 or 6 stockbrokers. That's because there's now reason to look for opportunity. And people are now saying, oh, okay, in Swaziland, the market has grown within Eswatini itself. So maybe there's something to tap into. But also, for us as a business, is we see opportunities, but we are confined to say, okay, we must work within the parameters, which means we can't shoot off the hip. And must emphasize that, because as entrepreneurs, we see opportunities where other people don't see, but those opportunities come with risks. I can imagine if we didn't have to look behind our backs to say, hey, who's going to come and slap us in the hand, the type of risks would have taken with people's money. But now we take measured risks. Because money by its nature, if it's not insured, it's in risky assets. And therefore, we as a business, and I speak now also as a representative of the Capital Markets Association, just on this point, we are now seeing growth and expansion in the ways in which we can play in the market. 2, we now have access to the regulator to influence and lobby and to push certain agendas that help us grow within the market as well. So, but as a business, it's been good. We now have a board. I never thought I'd have a board. But regulator says, hey, you can't be a one-man show here. So those are the growth pains and goodies that you eventually say, oh, now you look at yourself, you don't make personal decisions, you make professional decisions, and you have this guidance as you grow, and everyone is compelled. There are also growth opportunities for the sector. I mean, everyone needs to have a compliance. But I don't know, people aren't seeing the general compliance profession to allow. I mean, you've got so many brokers, so many cooperatives, so many intermediaries in that space. There's growth for the lawyers to play in the compliance space. But maybe they're still going to see what the opportunity is in that as independent compliance. But more than anything, for us as a business, we cannot attribute where we are to anything but the fact that there was regulation that said the market must look first at the entities that are operating a license and employing a Maswati. So and we took advantage of that opportunity, and it's been exciting.
That's beautiful. Thank you so much for that. It's nice to see that regulation works for you as well and has helped grow the business to what it is today.
Sure.
A lot of people tend to think that regulation protects the consumers. Would you say it also has protected the business?
Yeah, look, by protecting the consumers, you are protecting the business. Like I said, if had we not been operating within a regulated space, we would have done more risky decisions and put the consumer's money at a fate that we would not have been able to account for. And you've seen those gaps where that hasn't happened. But the regulations look out for us and allow us to grow, because it's not sustainable when you don't operate within the confines of the regulation. At some point you'll implode and you'll cause a lot of disharmony. And yes, where there has been gaps, it has affected us as a business negatively, because then there is, if you don't treat your customer fairly, it kills the trust for the sector. So the regulator, as much as we complain that they slap us a bit much, but they're actually enabling that the client who has 500 emalangeni or has 1,000 emalangeni and wants to trust you with their money, they know that at least you are compliant and you won't take their money and run to wherever. No matter we at Matla, someone is there to just keep you on check, and that's really the important thing. So yes, the regulator actually should not be looking out for the client or the end client. They should be making sure we look out for the end client, and that's really where we need to accept the regulator from. Yes, there are pressures to grow your numbers. Your board is saying, hey, you're a bit stagnant, and your shareholder value is required. But the regulator then gives that balance, that we don't run rogue in just chasing the numbers and the profits. So I'm happy in that space. I may not be happy that there's a burden on compliance, but I'm happy that there's regulation because it's saving me from myself, actually.
Sure.
Yeah, as an entrepreneur.
Wonderful. Mr. Nchalintshali, do you have any comments to that?
It's not reflecting on these submissions. You want to pick, to say, how do we close the gaps? How do we anticipate that some of this growth will come at pay? And in our instance, we are always monitoring a bubble. Is it on its way? You look at credit and you look at when you have got an expansive monetary policy, it's encouraging spending. Let's get business being active. Let's see cranes pulling out. And once that growth goes to a certain limit, interest rates are going to go up and they're going to curtail that. And what is it that they're going to do to your market that has grown to that level? We are anticipating issues to bring the safety. The gatekeeping role is very, and it may not be that rewarding to say I'm an entity that provides solutions to my consumers. But there's always this hawk above that looks to see if we are not dropping the ball. Because once that happens, then we're quick to clamp. In these issues, we don't graduate and say in 12 months we're going to take this action. Once we see some hit building up, we have to take action at that point. And that's where our entities then have to understand and be flexible to say, the modernized environment that we are in, it comes with certain responsibilities. He's highlighted it. And we've brought in governance guidelines that are saying you are coming into this space, we expect this structure to be in. We talk of fit and probity and rehabilitation criteria. Who is managing this business? Who is interfacing with the clients? Mr. Ngcobo has highlighted as well the ombudsman that is in there. And it's intentional that we are limiting the court process, not to say And our constitutional undertakings are saying everyone has a right to challenge of an audience, of seeking the audience of the courts. But within the legislative framework, the Ombudsman comes as a less costly, less formal, to say the provider that has been licensed by FSRA, you are licensed under certain conditions, that you understand what your role is. Now, here is a consumer that is aggrieved by your product. Let's sit. And that is why that person that heads ombudsman has to be at a level of a adjudicator to understand how the law works, and has to be even had audience in the courts. But what the determination comes out of that is not of an individual that was so far away from the process. Is of a mechanism, a dispute resolution mechanism that says, but this is your client. And these are the rights that the clients are enshrined in. You go to the Consumer Credit Act, it has come out quite clearly on what consumer rights are. I'm happy he touches on treating customers fairly, because that's the essence of it. You are a business that is serving the community. That community has to benefit as much as you benefit. The credibility and the confidence of the financial system rests with the regulator. The regulator now has to maintain a good temperature. And that temperature, I say without fear of contradiction, at times will tilt towards the consumer, because the consumer is a small man. But when you put them together, the entity is one that is a going concern, because they offer safe products.
Thank you so much, gentlemen. Mr. Ntshalintshali, as we bring this podcast to a close, can you tell us what's next for FSRA?
Thank you, Wanda. We are a regulator that always has to be cautious of the developing issues, the emerging threats, and what we want to be known as in the space. We've seen a heightened, or I would say accelerated move to adopt certain practices, as we call that top business. You know, we have fintech rolling out of our tongues. We're speaking of innovative means to reach our clientele and all that. But our legislation, you find that it's not as modernized when it comes to these products and the services that are offered now. So we have been in a planning phase as the FSRA to say risk-based supervision. What does it entail? How do we coordinate our mandate and our offering as a regulator? And what are these entities, these regulated entities, these licensed offices expected to deliver on? Mr. Ngcobo highlighted on IFRS 17 from IFRS 4. Those are standards. They come in the financial reporting mechanisms. Where we are at now is what are the early warning signals when we're dealing with an entity? What should we anticipate when we try to read and look through the returns that are given to us on a quarterly basis? Previously, we would go to an entity because we have not been to their premises for an outside inspection. It's been 2-3 years now. So we'll just go and remind ourselves of how, walk us through what has changed, what has developed, what have you introduced, and how is it playing with your clientele. We're finding that now that with the number of entities that we're supervising and the pace of innovation and growth in the space, you can't now rely on that. You have to now have a dashboard that tells you that I'm starting to have problems with ERC because I'm seeing something in their returns. What should tell me and lead me to that position? What are the metrics that as a regulator I deal with an entity and they also understand? So even in their now operations, there has to be some thinking and elevated kind of practice that says, when I offer these products, once I start getting a particular feel or inquiries from my clients, it may mean this. In our end, we want to stop the damage even before it forms. So we would know that as we are dealing with the lending, once we start seeing NPLs rising, then it means something. Why are people not paying their loans? What are the conduct issues? We have established a market conduct supervision and prudential supervision departments to solely look at those important areas. We've issued expectations, market conduct expectations. We've started rolling out now market conduct risk assessments. So when we're starting engaging with these entities, our expectation is you have done work prior before as we engage. So we give yourself assessment questionnaire and looking at these pillars that market conduct drives at. When we now come for the engagement, for us it's confirmation that you already are comfortable and in charge of your operation. And then we'll see the issues that was meant to build in. Legislation, amendments of legislation, now we're looking at to say as much as the market will move, it shouldn't then say whenever it moves, the legislation has to accommodate that. How do we come up with subsidiary legislation that is going to cater for the evolving nature of our industry? Previously, we were also dealing on a grandfathering kind of relationship. We are saying you are 5 years in as a regulator. Surely we are not going to have a 100% voluntary compliance industry. How do we get to that? That's our strategic intent. How do we get 100% voluntary compliance? It means some carrots now have to be given to the rabbits, and now we raise the stick and say, no, but we've spoken about this. And again, it's a predictable issue. We're not hiding this toolkit under our desks. We're bringing them to the knowledge of industry to say our administrative sanctions now are looking like this. If you are coming in last minute and say, can I have an extension of my submission of a quarterly report or an annual financial statement? For us, it really takes us a step back, because by the time we receive this information, we're already looking for certain things. So if it does not come on time, it then inhibits or compromises our action and our decision making. So we're then saying, no, now we're not going to agree to these extensions. And we have to now, maybe if you come with the extension, you also come with 150,000 check comparatively. But of course, that's not how you want to work. You want to limit the fines in your space because you want the market to quickly adapt and understand what the regulator is headed to. We've also set up a within market conduct, a consumer education and financial inclusion unit. Critical for a regulator. We have the set of financial inclusion which is tasked and mandated to carry on the national financial inclusion strategy. But we have a major role to play as a non-bank, a financial services regulator. So we are saying now, let us localize and let us ensure that we prioritize these areas. We used to go with road shows and they are effective, but we do see that now as the market evolves, we have to now look at different strategies to deliver our messaging. We've set up the EmpowerED Consumer to say, reach out to us. Even if you see that there's information, even if it's a licensed institution, reach out and I'm getting this product. They've licensed by you, but is this product really should be in the space, Some of this market intelligence, because consumers are on the ground, they help us even before it comes out to say they are now starting talking and enticing me to this thing. The regulator is not aware of the product that is operating in that entity. So it really helps to have that good relationship and that rapport with consumers and the investing public at large. So we are saying, as basic as it could be, but ours now want the legislation to talk. The legislation to be responsive and the regulator to be ahead of it. When entities are expected to comply, they're already at the full plate of information that they'll be operating from.
Thank you, Mr. Ntshalintshali. There's a lot packed in there. The future is looking bright. There's a lot to be done. We clearly have a long way to go, but we've also come an equally long way. Can't wait to see it. Can't wait to be a part of it. Mr. Magagula, what's happening in your space? What's the future of Umelusi Group looking like?
Well, thank you again, Ngozi. I will not maybe just speak of Umelusi itself. I think I'll speak of what we hope the industry will evolve to. First of all, there's a big opportunity, even from a licensing perspective, that the regulator could look into when you're looking at in the intermediary space, moving away from the broker style type to more an intermediary. It's good for that business. The person is not confined to commission. They can look at other ways and they can represent the client better. Because if I'm a broker for ESRIC, I'll push the ESRIC product. Yet if I'm just an intermediary and an independent one, I'll look at what's on the table for my client. And that's what we are hoping to do, even when we don't have to be selling to the retail market. Oh, we have a unit trust or we have this portfolio. It's the intermediary's role that will have to say, okay, client B looking at what's in the market. And that's where the advisory actually comes in. And that's where then people are not running to say, oh, we'll give you 12% if you take our product. It's the intermediary that is licensed that will then be forced to say, you must treat your customer fairly. You're not just pushing a product for company A or for company B when you're looking at your client. You look at what will be beneficial for your client instead of what will be beneficial for the commission payer. So we're hoping that industry will actually grow to that, because then we can all put our products on the table and they can question and they can be looked into in as far as representing a particular client's interests or a particular client's financial alignments. So that would be the first thing that we are hoping we're going to get the regulators to take us to. Obviously, as an entity, we wish to grow and look at managing more local assets, getting the entities with assets in SA to give assets locally. And we as an entity obviously are trying to make sure that we're no longer a post office connecting money and giving money to the guys all on the border. We are building capacities such that we can trade the exchange, not only the local exchange, but also the JSE or whatever exchange that there is, because we think we must grow to that level. It's got its pains because maybe we're a bit ahead of the curve in our thinking, but there shall come a time where the offices are not, the local entities have enough confidence in the local businesses to say we can create portfolios, we can give the right performance in line with our peers in South Africa. They may have the track record, but we are saying we must start now to create a track record, because if we don't, even in 5 years' time, they'll say, but you've never done this before. In 10 years' time, so we have to start and get the market to have confidence in small monies to say, okay, you go and trade there, and we have to manage the downside. But that's where the regulator then comes in to say, okay, we see you are now playing in this type of space, but how do you manage that you don't lose money? So that's where we think the industry is going to go to. And us being ahead of the curve is really about saying we're setting the pace for the regulator and for the market to say, look, you're managing us as offices to transport money, but now you need to manage us as actual portfolio managers to say, are we picking the right stocks? And therefore, we are also hoping that the Eswatini Stock Exchange in the near future will also be vibrant, so that we can buy stocks on the local exchange. And therefore, that's what we are driving as we grow as a business. So yeah, we're living in interesting times and we look forward to a bright future.
Interesting times indeed. Mr. Ngcobo, hopes and dreams for the industry, for ESRIC?
Thanks, Nwanda. Let me start off with the industry. Actually, we have come a long way. And I must commend the office of the regulator that has been driving that whole process. I think one of the areas that we still need to work on as an industry is issues of inclusivity. I think the issues of microinsurance. how does someone insure his cows and other valuables, as it were? Because we still have some people that believe no, insurance is not for us. But truth of the matter is we still need to do more. We still have houses and structures in the rural areas that we believe should be insured as part of that risk management framework, even going forward. And we must make insurance affordable. I think that's one of the areas that we have seen, which is what we've seen, actually, the quality of the products and also the prices that you get. 10 years ago, the price for the same amount of cover is totally different from what we have now. And clients have a choice now in terms of where they want to place their business. And that choice is also sitting within all regulated industries. One of the areas, of course, is innovation when it comes to the insurance industry. We have always been seen as people who are not very innovative. But I must say I'm happy with the developments we've seen in terms of the local market, how they are interacting with clients, moving away from paper-based interactions to even more efficient, which speaks to even to the cost structure of that insurance company. So those are some of the areas in terms of that. And of course, risk management within the organization. That due diligence when we want to roll out new products. Have you given yourself time in terms of making sure? And of course, that guidance from the regulator. We are aware that the regulator speaks to other regulators within the industry and across. So what we know then is that we are benchmarked against the best in the world, and we will continue to listen to the regulator, provide support where we can, but most importantly, have the consumer at the end benefiting from everything we do as an insurance industry. Thank you, Novanda.
Thank you so much, gentlemen. Thank you, Mr. Ngcobo, Mr. Nchalintshali, Mr. Magagula. It's been wonderful getting this insightful views and perspectives from you. Thank you for sharing your different journeys with us. I think I speak for all the viewers when I say that we've really appreciated the wealth of knowledge and information that we have received from you. To the viewers, I think it's evident that regulation is not just about limitation, but it's about collaboration, protection, and promoting sustainable growth for all. With that said, from the Empowered Consumer team, it's goodbye.